Hello and welcome to the August edition of the Nutmeg Investor Update. I'm James McManus, Head of Investments. As usual today I'll spend a couple of minutes explaining how portfolios are currently positioned, and then I'll explain what happened in markets in July before delving into the broader economic backdrop and how it's contributing to our investment team views. What are the latest changes for Nutmeg portfolios? Well, we didn't make any significant adjustments to the way portfolios are positioned over the month. Although we continue to closely monitor market events, we believe our portfolios remain well positioned for the current market conditions. Equity exposure in our portfolios remains overweight. We continue to favour the US and maintain our US equity overweight relative to our long-term benchmark. Our portfolios have a broad US equity market exposure, but we've also built a more targeted position in large US financial companies, which we believe are particularly well supported. Another more sector-specific view we have is on European industrials, which we think will continue to benefit from the long-term support of increased infrastructure and defence spending in the region, and as a result, we're overweight here too. Conversely, we're happy to remain underweight UK equities relative to our long-term benchmark for now. We believe both mid and large-sized UK companies are facing headwinds. We also believe the outlook for Chinese and emerging market equities looks challenging. They face macroeconomic difficulties tied to both the US tariffs and a weaker US dollar, and our portfolios therefore reflect this. In terms of fixed income positioning, our government bond exposure is in line with our long-term benchmarks, the team having recently taken the decision to lower our holdings in longer-term government bonds. Major central banks have generally been in a phase of lowering interest rates. However, the persistence of inflation and uncertainty about how it will be impacted by the US tariff policy means that the outlook on monetary policy is now more clouded. We do have more exposure to corporate bonds than our long-term benchmark, especially in high-yield corporate bonds, also known as high-yield credit. We believe high-yield credit can generate compelling returns that are less contingent on the policy backdrop and more linked to the positive shape of the global economy. What happened in financial markets in July? Well, for global equities, July was a positive month overall, with most major stock markets moving higher, and that was despite a bit of a sting in the tail with the US president announcing further modifications to US tariff rates on the last day of the month. In the US, the S&P 500 and Nasdaq indices both hit fresh record highs late in July before that last gas tariff news took the shine off things during the first day of August trading. The indices are still both showing year-to-date gains, having recovered from that sharp sell-off between early February and the start of April. Large UK companies, such as those traded on the FTSE 100, also reached new highs in July and ended the month ahead. Chinese equities made gains despite a late dip, whereas European equities, reacting much more strongly to the latest tariff news, ended the month lower. In fixed income, government bond prices fell in the US, Europe and UK, whilst corporate bonds also declined slightly. What was behind July's market movements? Well, when the US Republican administration announced the so-called Liberation Day tariffs introduced in early April, many investors initially feared the worst in terms of the ramifications for global growth. Most of the tariffs were quickly paused, and in the time since, individual countries have been busy thrashing out their own deals with the US. Now, much still hangs on how US tariff talks progress. The situation is clearly shifting frequently, and a lot is still unknown about where and when they will settle. That said, investors have generally been encouraged by the Republican administration's apparent openness to enter tariff discussions and its willingness to delay some tariff implementation deadlines. What's more, the global economy has, on the whole, been more resilient than initially anticipated. In fact, the latest data suggests both US and European economic growth was stronger in the second quarter of 2025 than expected. The UK economy looks to be on a slightly less stable footing, but investors responded well to the US-UK tariff arrangement reached in May, which secured a lower tariff rate than the EU agreed with the US in July. And on top of that, there have been really encouraging signs from earning updates. US equity earnings for the last quarter of 2024 and the first quarter of 2025 have been especially robust, and we expect US earnings will also beat consensus for the second quarter of 2025, helped by a weaker US dollar. So overall, equity investors are still in pretty good spirits. Bond markets are a slightly different story. A big part of valuing a bond comes down to what its future cash flows are worth today. Inflation expectations are important to these calculations, so bond investors don't like it when the inflation outlook becomes muddied, as it is today. Inflation has on the whole been trending downwards, and this has been allowing major central banks to steadily cut interest rates. In theory, rate cuts should push bond yields down and therefore bond prices up. But while the initial tariff shock has faded, it hasn't disappeared, as we saw from the latest announcements. The impact of tariffs on inflation in the US and beyond is yet to be fully understood, which makes life difficult for central banks that set those policy rates. Until the long-term impact on inflation is better understood, some bond investors are holding back. As we touched on earlier, that's why we're keeping our government bond exposure more limited. To find out more about the investment team's market views, head over to the Insights section of our website and take a look at our investment outlook, Summer Check-in. It's a deep dive into the themes we identified at the end of last year for our 2025 outlook and how they've developed. Thanks for watching. As always, if you have any questions or topics you'd like us to discuss in next month's investor update, you can contact us via social media, email, or in the comments section below this video.
As with all investing, your capital is at risk. The value of your portfolio with Nutmeg can go down as well as up, and you may get back less than you invest. Past performance and forecasts are not a reliable indicator of future performance. We do not provide investment advice in this update. Always do your own research.